Good afternoon,
So
everyone. Thank you for joining us. Today's session will feature a presentation from Tony. He is a trained estate and tax planning accountant and life insurance advisor. Before founding AMS Wealth, Tony held various director positions within wealth advisory firms. Tony has provided insightful information on matters regarding personal finance, tax, and estate planning to various media outlets such as the Financial Post, the Globe and Mail, Advisor.ca, and has appeared as a guest on BNN Television and CBC Radio. Tony has tutored for the CPA Canada in-depth tax program and has been a facilitator for the CPA Ontario program. Good luck, Tony, on your presentation, and I'll try to circle back at the end just to help close things out, okay?
excellent. Thank you for having me.
Thank you.
Here's the typical legal disclaimer. So the information you're going to see over the next 29 minutes or so, don't hold me accountable for it. It's very client specific and fact specific. So it's just general information for everyone listening in. If you hear my dog barking in the back, he's having a little bit of a rough day today. So I'll let everyone know that could happen. When I look at my focus, this one sentence and this one liner really kind of screams to what I'm talking about and what I believe is important. Real estate is to wealth creation what life insurance is to wealth retention. So oftentimes I'm speaking to business owners, people with appreciated capital gains on real estate properties. Never is it my intention to tell the client or the person I'm speaking to that what has made them successful is not the right strategy going forward. What I suggest is always to complement what they've built up until now. And so to add a different asset to their mix, not to necessarily go away from what they've built up until now. A little bit of a tax update. I know this is a tax session. So we have capital gains exemptions available in Canada. Just under $900,000. You need to meet a bunch of rules and tests in order for you to qualify. Definitely with your advisors and your clients, when we're looking at having people qualify for the exemption, it's not an easy test to meet. And so a lot of business owners believe that they can sell their shares and meet this exemption. Not necessarily the case if they're not properly structured. And there are other circumstances to consider when looking at that. My main point in saying this to the audience is that don't allow people to assume that they're going to either pass away or sell shares of a family-owned business without paying tax and qualifying for the exemption. Can life insurance help and potentially hurt meeting the qualification exemption? Yes, it can. So that's why it's really important to kind of get that straight when we're doing this kind of planning for clients. My primary focus will be subsection 70 sub 5 of the Income Tax Act, and that leads to a deemed disposition upon death. So this is a tax session. You will never pay a bigger tax bill than when you die. Most likely that's going to hold true for a lot of people. So if you've never been in this position before, it's kind of like surreal to think that the biggest tax bill you're going to have is probably when you pass away. But in a lot of cases, it's the truth. In Canada, I mean, we have a deemed disposition provision, which tells us that our clients are going to be taxable on the appreciated gains of the property that they've owned at the point of death. There are some exceptions, there's a spousal rollover and whatnot, but generally speaking, the deemed disposition rule is what leads to a cash problem. And so when you have a tax liability and you don't necessarily have the cash, that could be what's then we call a liquidity problem. It's not that the person has sold and physically received cash and then they pay their tax. They've passed away, they haven't really sold anything, and they have a tax bill to pay. And don't believe that this is only applicable to the high net worth families with private company shares. No, this kind of general philosophy applies to registered plans. So think about our RIFs, RSPs. These are things that are generally taxable upon death. Non-registered investments, cottages, rental properties. And so we're going to go through a few examples where we're going to start quite simple on the, I would say probably the easier side of the equation, which is take your typical family with a cottage. What happens there? Is it taxable upon death? What are people doing? And we'll go from there. Canada has no federal or inheritance tax. So the tax that's applicable when you pass away, it's a deemed disposition tax. Very different from the United States. The United States, there is an inheritance or a US estate tax, and that is applied to your total worldwide estate value, as opposed to Canada, where we're triggering inherent capital gains on property for the most part. And so these type of conversations are very relevant to family-owned businesses, to real estate builders, investors, developers, people that have built wealth in capital assets and don't necessarily have all of the cash lying around to just pay that CRA tax bill when they were to pass away. Oftentimes, we recommend an estate freeze for a lot of family-owned businesses, and that's a great tax transaction to prevent this terminal tax liability to grow any further, but we still have to address the tax liability that is being frozen. So don't think that an estate freeze solves all problems. I think an estate freeze is a great tool, and if used appropriately. And we need to look at how do we address the tax problem that is already embedded, which is why an estate freeze would be recommended in the first place. So some myths. Life insurance is a scam. Life insurance is only good when you die, and life insurance is costly. So it's just like saying every lawyer or an accountant or professional is a scam. Not necessarily true. It's a great tool. If used appropriately, it could be a valuable asset. Number two, life insurance only good when you die. Not true. You could actually use insurance in your retirement. You could use it during your lifetime to leverage or sell off. And number three, life insurance is costly. Not when you're looking at what is the opportunity cost when you're not doing your insurance planning properly. So think of someone passing away with a $3 million tax bill, $1 million tax bill upon death. The strategy in using insurance to cover that terminal tax liability should be only a fraction of what that ultimate cost is going to be. When I'm using insurance and planning with clients, we're going to primarily look at these four things. So tax on death. What is that tax bill on death? Is it still growing? How big can it potentially get? Buyout of family members. So how does that happen? What is the tax treatment of that transaction? Can you actually use insurance to build a retirement asset? And what's happening with the federal versus provincial small business deduction grind when we have associated companies earning passive income? So we're going to start really easy, and we're going to start with the family cottage. What's happened with cottage valuations over the past, I don't know, let's say 16 months? Cottages are significantly increasing in value. And so what happens with that is subsequently, for estate planning purposes, ultimately the tax liability that is going to be resulting from this cottage is going to likely be larger. So as valuations go up, tax liability as a result of that goes up. So the same kind of fundamental concept applies to privately owned family businesses. If we're in a time where there's high valuations for a family business, if we're in a time where there's high valuations for real estate, the resulting cash problem or liquidity problem is going to be larger. When I meet with people and when I speak to clients about this kind of planning, oftentimes people always come up with the solution, and the solution is, well, instead of it being taxable when I die, I'll just gift it today. Not necessarily the way to go. So if you gift it today, most likely there would be a tax liability triggered today, and you don't want to do that, and you're going to lose control of the asset. So it's not as simple as saying, let's just gift the property today. There's a lot of consequences that come as a result of that. And primarily, we're looking at a potential tax liability that's triggered today, and primarily we're looking at the loss of control of the asset, which can be more significant than what we give it weight for. So take a primary example. Dad and mom have a cottage. They know that's going to be taxable on death, and so they gift it to their son. Their son gets into divorce or into creditor problems, gambles some money away. Now somebody has a claim to the cottage where mom and dad still want to enjoy. So likely not the way to go in a lot of cases. Let's use a simple example to look through the math. We have a Muskoka cottage, it's worth $1 million. We bought it for 500,000, so we have an inherent capital gain of 500,000. Let's assume that we have a tax liability today of approximately $133,000. So very common sense, as property values go up, the inherent tax liability also goes up. And so I'm going to round up that tax liability problem to $150,000, and that would be cash payable when the owner passes away. So who are the owners? So I have a husband and a wife who are 60 years of age, and we have an estimated tax bill on death on this cottage of about $150,000. What is the cost of insurance for $150,000 of life insurance? It would be $2,400 a year on a second to die policy. Okay, so let's say that again. So when mom and dad both are to pass away, there's an estimated tax bill of $150,000. In order to keep the cottage in the family, we would need to pay this tax bill. We could also sell the cottage to pay. So that's always an option. When I meet with clients, I always say, no matter if we're talking about real estate, cottages, private family and businesses, 3 options to fund this liquidity problem. We could leverage, we could sell, or we can insure. So when you have a capital property that's deemed disposed upon death, you could either sell it, you could leverage it, or you can insure it. And I can assure you that insuring it would be the least costly of all of those options, 99.9% of the time. So in this scenario, husband and wife are both 60. We have $150,000 of a problem to solve, and the solution would cost $2,400 a year. And this is a lifetime solution. So as long as the couple lives, we're paying $2,400 a year. And that would be the ultimate cost to get $150,000 of a benefit. So it should work out to a good return on investment, depending on the life expectancy of the family. What else do we do? Shareholder buyouts. So when we get into shareholder buyouts, it's very important to look at where's the cash and how is it treated. So we get into some more complicated planning. We look at how do the shares of a family-owned business get bought out? Where's the cash to do so? And ultimately, what's the tax treatment on that distribution? So oftentimes people overlook the planning required to make sure that we get the treatment we want on that buyout. So for example, would it be considered a capital gain or would it be a dividend taxation? A lot of the times we look at equalization of next gen. So when we look at tax upon death and we look at liquidity and payouts, family businesses represent a significant amount of wealth in this country. And so we look at where do we divide the family assets if the family business represents a significant portion of the estate. So not only do we have that subsection 70 sub 5 problem of deemed disposition upon death, we also then have a problem of how do we equalize siblings that are not going to be part of the family-owned business. I'm going to, so this is an example where we have a young female. So if you look at the top right-hand corner, you'll see female age 40, and we have insurance being used as an investment. So in this case, if you think about passive rates of tax inside a corporation, so in Ontario, if you're earning passive income inside a private company, you're paying 50.17%. And so is there a better alternative to create corporate wealth so that you're not having that tax leakage every year of 50% on passive income? So you would see female age 40 with 50,000 of a contribution inside the corporation a year for 10 years. By the time this female gets to age 65, which is highlighted in yellow, we would have an investment asset inside the insurance of approximately $1.3 million. So the deposits were 500. We've more than doubled the deposits in terms of getting access to investment value. And that investment value can be used during the remaining lifetime of this female during retirement. So when we compare this to an alternative investment, what kind of net return would this person need to beat this as an investment? And the net return would be not available in the open market with passive rates, with the low interest rates today. So if you're losing 50% of tax every single year, you would need high single digits to outpace this return, which is typically not available in today's low interest rate environment. Okay, we're going to get into really the meat and the potatoes of this. I know it's 30 minutes. I'm flying through this material, but I wanted to touch on as many things as I could while still covering enough of each topic. So primary focus of deemed disposition upon death is we have a liquidity cash problem. So how do we address that cash liquidity problem? When you're planning for clients and when clients have corporations paying 50% tax, is that really the best use of capital? And sometimes this also applies to the personal context when we have highly paid T1 clients or T1 individuals earning in excess of 220,000 and paying the highest rate of tax. So over the course of the next 14 minutes, I'm going to look at 3 case studies which touch on these issues that I've been talking about until now. I think that these hopefully highlight the importance of planning and estate planning prior to death and what could happen if you don't. This is my favorite case. This is kind of the first family business I worked with several years ago that it's really stuck with me. So take a traditional family business. They do an estate freeze, great transaction. The estate freeze is a $5 million freeze. And this $5 million freeze was done with the original founder. He passes away, he leaves, the shares roll to his spouse. And on this freeze, there was no conversation of insurance planning or estate planning or anything like that. It was just a freeze and a tax transaction to not allow the tax liability upon death to get even larger. And this widow, she was looking at her estate planning. She was looking at leaving an inheritance for grandkids and all that. And all she really owned were $5 million of preferred shares, and she owned $2 million of an RSP. That's really the only assets she had. So she had a paper that was worth $5 million, preferred share, and she had $2 million in her RSP or RIF. And she didn't know that her RIF was going to be fully taxable upon death. And so the $2 million becomes $1 million. And she was going to have a tax liability owing on these $5 million of preferred shares. No insurance planning was done to cover these exposures. Really kind of an unfortunate situation because the second generation or her son ran the family-owned business and relied on the income from that family business to support and feed his family. So we sometimes look at what are the tax transactions that can help a client today, and most popular is the estate freeze. And then we look at what are the tax transactions that can help a client when they pass away, and we have these conversations between pipeline and loss carryback under 164.6. Great transactions. They're great transactions for clients that should be considered, that should be done. However, if there's no cash to ever solve any of the problems in a tax efficient manner, then is the client really getting well serviced? And I'll tell you why insurance specifically and life insurance inside a corporation is so valuable. It's such a valuable tool. Number one, the investment value, as you saw there on that younger example, grows tax deferred. Number two, it pays out tax free to the corporation and allows that primarily most of the proceeds, if not all, can come out through the CDA account. That's wealth retention. That's how we retain the wealth created by a lot of family businesses so we can move wealth from one generation to the next. Next case, we have a professional who's expanded his net worth, and he and his wife got involved in separate businesses. A really, really smart individual, a well-respected doctor in the Toronto community. They're in their mid-50s, approximately $20 million net worth. And together with their accountant, we have a $4 million expected tax bill upon death. So again, subsection 70 sub 5 tells us that there's a deemed disposition upon death. The three kids are not involved in the family business, and they have no expectations to become a doctor. So we have passive cash inside the corporation, and how do we tax efficiently get $4 million to the estate to pay for this tax bill when we have these corporations lying around? So what does the math really look like for a couple in their 50s to solve a significant $4 million problem? Is the myth that insurance is costly? Is that true when we look at problem and solution? So the problem for this family is they have a bunch of wealth tied up in private companies. When they pass away, there's a tax bill owing to the CRA. Be mindful that the tax bill owing is a personal kind of level tax problem. So with a lot of clients, we have family businesses, real estate, investments inside private companies. How do we get out the value of those private companies to then pay for this tax problem? In this case, we're talking about $4 million. So here's the math. This is, again, a joint last die policy. So if we're looking at getting $4 million out tax-free, what's it going to cost? Is insurance, in fact, costly to get a $4 million solution? So in this case, it's about a quarter. So I'll say that again, it's about a quarter of a cost to get the death benefit of $4 million that we need. And this is, by the way, it's a general rule of thumb. If we're dealing with people in their mid-50s, and insurance is very sensitive to age and health, so I don't think that should be surprising to anybody. So depending on your age and depending on your health, insurance can be a great investment tool. This couple in their mid-50s were aiming for a $4 million solution. How much is it going to cost the corporation? Just under $1 million. So 1 to 4. And so rule of thumb, we should be at about 1 to 3 or 1 to 4. So if we're looking to get anywhere from 3 to 4 million as an ultimate goal, it should cost us about 25 to 30% in deposits to get to that goal. And primarily, again, it's going to be a tax-free distribution, a tax-free payment to the corporation, and ultimately a tax-free distribution outside of the corporation, which allows for such great rates of return when you're planning to retain wealth in the family business. And my last case, real estate developers. So not everyone loves debt, but some people do. And real estate investors and real estate developers are really comfortable dealing with mortgages. We are in a very ultra low rate environment. So these cases come up often for me, and we're going to go through a scenario where we do have kids that are involved in the family business. We do have kids that want to take ownership of the family business to the next generation, and we have a significant $9 million problem upon death. So how do we pay for this $9 million problem upon death? Oftentimes people think that if you have a $9 million problem upon death, you must have $9 million of cash lying around to pay for this problem. Not the case. So typical real estate families, very asset rich, cash poor. We have a lot of value in land, a lot of value in real estate, and there isn't necessarily all of the cash flow to make all of this work in the most efficient way possible. So what is the solution for this real estate development family? We want to get a plan in place where we don't completely kill the cash flow of the business. And so a priority for this business is they want to fund the tax bill on death efficiently, but they also need that cash to reinvest into their own business. So the opportunity cost of giving those deposits to the insurance company is just way too high because they're getting 10, 11, 12% on their own money. So in this environment, and specifically with such low rates of interest in terms of costing debt, What we do is we have a leveraged strategy for the family. So every deposit that goes into the life insurance is leveraged back for the family for them to use in their own business. Why do people do this? Well, this is a tax session, so I have to refer to the tax legislation that provides for tax deductions in this strategy. We have an interest deduction, which is provided pursuant to 20 sub 1C, and we have a portion of the net cost of pure insurance, which is provided in a subsection just after that, or a subparagraph in E.2. By people getting into these planning arrangements, they are able to first deposit money into an insurance product or solution that grows tax deferred. Secondly, they leverage the money back at an interest rate of, call it 3%, to invest the money in their own business. When they do that, they get a tax deduction for the interest, they get a tax deduction for the insurance, and the insurance asset grows tax deferred. But remember, the biggest point of the plan is to get to funding that $9 million ultimate problem. So what does the math look like? So this is what the math looks like. An annual deposit invested into the insurance product is leveraged back. And in this scenario, I assumed an interest cost of 3.5%. That becomes the ultimate cash cost for the client. The cash cost for the client becomes the interest carrying on the loan, which are then provided with tax deductions inside the corporation. How much is the tax deduction worth? Depends on what's the tax rate we're talking about. So these type of strategies are very effective, specifically if we're looking at clients paying 50% or more in tax rates. Sometimes when people are running active businesses, they'll be paying 26%. So that also becomes a pretty attractive return on investment when you can benefit from a tax deduction at those rates. We don't have the time today to look at through this math. That would be a whole other session on its own. So I've summarized the math on the next slide. So all of that math, what does it really show us? So I always tell people you can do nothing and you can self-insure. And so if you self-insure, depending on your situation, how much is it going to cost the family to get you the 9 million? So if we do A, which is do nothing, and the family is going to pay for the bill on their own, it's going to cost the corporation 12 million to get 9 million out. If we use a fixed insurance approach, people sometimes don't like leverage. People sometimes don't like anything complicated. So plain vanilla, it would cost 4.2 million to solve a $9 million problem. If we do the leveraged approach, which is the slide we just saw, given the tax deductions available, given the life expectancy of the family, what is the pure ultimate cost? It's 2.5 million to get to a $9 million solution. So when you look at the gap between the self-insure and the leveraged insurance solution, we're looking at about $10 million of family wealth that we're able to retain and pass on to the next generation. So super tax efficient because of the attributes provided not only inside of the insurance contract, but also tax provisions inside the private companies that most of our clients are going to be building their wealth in. If used appropriately, these strategies work very, very well for a lot of family-owned businesses and real estate owners. And that's my contact. And I'm surprised myself that I was able to get through all this in under 30 minutes.
Hi there. Sorry, I don't mean to just interrupt in your presentation here. Do you mind just putting that contact information in the chat, whether it's your email, LinkedIn, or any other links that would be helpful for our viewers?
So I put my email in there.
Yeah,
Did you see that?
Yeah, I do see that. Yeah, just so if viewers, they want to, maybe they have questions after the event today, they can contact you and they can ask you their questions. I'm just going to check here just to make sure there isn't anything else. I don't see anything in the Q&A right now. Whoops. Yeah, there's nothing there. That's okay. Is there anything else that you just wanted to add just before we go to the main
If people
stage?
do have, yeah, if people do have questions, happy to talk through it now. Happy to talk through it offline as well. Um, it's a lot of info and very little time, so.
Okay, perfect. Thank you so much for your time today and your topic, presenting on your topic today. The panel is starting on the main stage, so if everyone can head over there, and that'll be until 4 o'clock.
Thank you.
Okay, thank you.